Hello, welcome to the Wealth Starting Line. Don't forget to like, comment, share, and subscribe.
Hey, welcome. Today, we're digging into a topic that's, well, as old as money itself, gold. You know the old saying, right? When the world gets a little crazy, you run to gold. But is it really that simple? We're going to peel back the layers on that one and get to the real story of what makes the shiny metal tick. All right, let's just jump right in with a big question. When the stock market's a sea of red and everyone's whispering about a recession, the old wisdom tells you to pile into gold. It's supposed to be the ultimate safe haven, an anchor in a financial storm. But as you're about to see, the connection between a bad economy and a rising gold price is way more complex, and honestly, a lot more fascinating than you probably think. So, to get our heads around this, let's start with the big picture. The simplest way to think about how gold and the economy relate is like a seesaw. Seriously. When one side goes up, the other tends to go down. This is the classic view, and you know what? It's a really good place for us to start. Think about it. During an economic boom, everyone's feeling confident, right? Optimistic. You want your money to grow, so you pour it into things like stocks and bonds. And in that kind of environment, gold, which kind of just sits there and doesn't pay you anything, it looks a little, well, boring. But then, when a bust hits, that whole psychology just flips on its head. Fear takes the wheel. Now, investors aren't looking for growth, they're looking for safety. They just want to protect what they have. And that's when they rush back to gold, driving that price right up. Now, this whole behavior, it actually has a name. In the world of finance, an asset that does well when the economy is struggling and not so great when the economy is booming is called counter-cyclical. It literally moves counter to the economic cycle. And for a long time, this has been gold's claim to fame. It's how it earned that reputation as the ultimate safe harbor. And right here, this is where we take a turn. Because if you walk away just thinking bad economy equals high gold price, you're only seeing the shadow, not the thing that's actually casting it. A slow economy isn't the direct cause. Nope. It's more like the catalyst. It kicks off a whole chain reaction. And it's that reaction, the stuff happening behind the curtain, that really moves the price. So let's go behind that curtain. Let's get into the engine room and see what's really going on. It turns out there are three sort of fundamental forces that are the true drivers of the price of gold. And once you understand these, you pretty much understand the whole game. If you only remember one single thing from our whole chat today, please make it this. The single biggest, most important factor that influences the price of gold is real interest rates. Not the economy itself, not the stock market, this one specific thing. It is the absolute heart of the entire story. So how does this actually work? Let's just walk through it. First, the economy starts to look weak. What's the knee-jerk reaction? Central banks, like the Fed here in the US, they cut interest rates. They want to make borrowing cheaper and get people spending again. Okay, now here's the crucial part. Gold doesn't pay you any interest. It just sits there. So if you could put your money in a super safe government bond and earn, say, 5%, holding gold instead means you're giving up that 5%. That's what we call the opportunity cost. But when central banks slash rates down to almost nothing, that bond might only pay you 0.5%. All of a sudden, the cost of holding gold, that return you're missing out on, is tiny. Gold becomes way more attractive compared to everything else. And boom, the price goes up. Okay. So we've got the number one rule down, follow the real interest rates. But I know what you're probably thinking. What about that other word you always hear with gold? Inflation. Everyone says gold is a great hedge against inflation. And yeah, it can be. But that relationship is a lot more subtle than most people think. Just take a look at this. In what they call a Goldilocks economy, not too hot, not too cold, with steady growth and low inflation, gold actually does pretty poorly. But if the economy starts overheating with high growth and high inflation, gold starts to look better as a way to protect your purchasing power. But here it is, the magic combo. The perfect storm for gold is stagflation. That's the worst of both worlds. A stagnant, barely growing economy combined with high inflation. In that mess, people are scared of everything, the economy collapsing and their cash becoming worthless. Gold suddenly looks like the answer to both problems, and its price can absolutely take off. And the third and final big driver is the US dollar. See, the whole global market for gold is priced in dollars. This sets up a really simple, inverse relationship. When the dollar is strong against other currencies, sure, it takes fewer dollars to buy an ounce of gold, but it takes way more euros or yen. That makes gold more expensive for all those foreign buyers, which can hurt demand and push the price down. And on the flip side, when the dollar is weak, gold suddenly looks like a bargain to anyone holding another currency. Demand goes up, and so does the price. All right, so now we have our framework, right? It's really about real interest rates, what kind of inflation we're seeing, and the strength of the US dollar. That's the theory. So, you know what? Let's put it to the test. Let's look back at some of the biggest economic crises from the last couple of decades and see if our new model actually holds up in the real world. This timeline basically shows our framework in action perfectly. Look at 2008. The financial crisis hits, central banks unleashed this massive thing called quantitative easing, or QE, which just crushed real interest rates down to zero and even below. And what did gold do? It soared. Then, jump to 2013. The US economy is getting better, and the Fed starts hinting about ending QE. You might remember the taper tantrum. The market immediately thought real rates were going to rise, and what happened? Gold fell into a slump for years. And then, 2020. The pandemic shuts down the entire global economy. The response? Even more QE, rock-bottom interest rates, and just total uncertainty. The result? Gold shot up to a new all-time high. See? In every single case, the price of gold didn't just follow the economy. It followed the policy response to what was happening in the economy. So, after digging into the mechanics and looking at history, we can start to build a new, much sharper way of thinking about gold. It's time to kind of throw out that overly simple safe haven idea and replace it with something a lot more powerful. This quote really just nails it. Gold isn't so much a measure of economic activity, it's a measure of economic confidence. When we all feel confident about the future, about the financial system, about what central banks are doing, gold just doesn't look that appealing. But the second that confidence starts to crack, gold's appeal goes through the roof. And that's the bottom line. The big takeaway here is this. Don't just watch the economic data, like the GDP number. Watch how people, and especially how central banks, react to that number. The story of gold's price isn't about spreadsheets and data points. It's a very human story about fear and the huge systemic responses that fear triggers. It's a barometer for our collective anxiety. So here's a final thought for you. The next time you see those headlines flashing about gold hitting new highs, just pause for a second and ask a different kind of question. Instead of asking, what's gold worth? Try asking, what is everyone so afraid of right now? Is it inflation? Is it a recession? Is it the policies being put in place to fight those things? Because the answer to that question, well, that'll tell you everything you need to know, not just about gold, but about the world we're living in. Thanks so much for tuning in.
Thanks for watching. Don't forget to like, comment, share, and subscribe. See you next time.